Okay, welcome to episode 2 of Investment Banking Secrets on a very rainy South African evening. Today, we will be running through two questions that were asked in the previous webinar, and we'll also go further, a little bit deeper into some of the concepts that were covered in the previous webinar. So, the first thing that we're going to look at is break-even analysis in financial models. This is the concept that just goes a little bit deeper than what we were doing last week. And we'll then do due diligence in the mining industry, which was a question from last week. And we'll do levered versus unlevered beta, and when to use which when you're doing valuations. So let's hop right in. Okay, so the first question we have to ask ourselves is, what is a break-even analysis? So a break-even analysis, to look at the first point there, it answers this question. What is the minimum value for a specific revenue driver, or the maximum value for a cost driver that ensures that we are either profitable, we meet our covenants, or we can actually pay our debt? So let's break that up. A revenue driver. So, for instance, in the mining industry, we have revenue drivers that are in the form of the commodity price that we sell, the specific level of output, maybe the exchange rate. And these drivers are just the individual factors that affect the profitability of the organization. So by saying we're going to run a break even on a revenue driver, we can find that price for the driver that ensures that we neither make a profit nor a loss. In other words, any value below that driver and our organization will be loss making. So this is very important for us, especially if you're in the debt lending space and you want to lend an amount of money to an organization. And in this instance, let's assume it's a mining company. And you know that currently gold prices are at record highs. You want to know, can this company still survive if the gold price suffers dramatically? Is it still a good investment to lend this company any money? Okay. A better question to actually ask yourself is, what's the minimum gold price that the market can offer this company, such that any gold price below that minimum, this company is not going to be able to either be profitable, to meet its financial covenants, or to pay back its debt. And we'll explain what financial covenants are a little bit later. But basically, you're just asking that question. On the other side, you can also look at it from a cost perspective. You can say, I want to lend this mining company money, and I want to know, because in South Africa we have got very strong trade unions. You can ask yourself, every year the trade unions bargain for higher wages. What is the maximum amount that this business can offer the trade unions such that this business still remains profitable? And the only way you answer that question is via a break-even analysis. Okay, so that is basically what a break-even analysis answers. It finds the minimum value for a revenue driver or the maximum value for a cost driver such that the business just breaks even. In other words, it's neither profitable nor loss-making. And any movement in excess of that break-even price, in other words, if the revenue driver falls below that break-even price, then we're in trouble. We're loss-making, or we can't make our meet our covenants, or we can't make our contractual capital and interest payments. Okay. So the next step, we then compare the break-even price or value to current market prices to see whether or not our organization is in fact in good shape. Okay. So in other words, if you look at a mining company currently, if the mining company has got all-in cash costs, so it costs this mining company $1,000 an ounce to bring that ounce of gold out of the ground and to sell it. And we have the gold price close to $2,000 an ounce. Okay. Let's just do a back of the matchbox calculation to assume that the break-even gold price is then $1,000 an ounce. So the current market price is $2,000 an ounce. but this company breaks even at $1,000 an ounce. So if things stay the way that they are, this mining company is in pretty good shape. However, if you look at another mining company, and maybe that mining company has got all-in cash costs at about $1,600 an ounce, maybe that mining company is in slightly worse shape than the mining company that has got a break-even price of $1,000 an ounce. So it all has to be put in context, and it's all relative. Okay. So the third point is that break-even levels of about 20% or more were thought to be robust pre-2014. Nowadays, banks rely more on Monte Carlo-based simulation. So what happened in 2014 was that the market saw one of the biggest commodity price nosedives in history. So I've just got a graph that illustrates that. You had iron ore going from about $140 a ton, and it just crashed throughout the year in 2014 and somehow steadied out at about $50 a ton in 2015. So that was a tremendous crash. And before, when I was working in the bank, we had a huge deal that was for one of the largest iron ore producers in Africa. And we thought that we were in pretty good shape because when we wrote the deal in 2012, the break-evens showed that iron ore could drop more than 25%, and this company will still be able to meet its debt obligations if it just leaves the business case as is. It does nothing. And yeah, we thought we were in pretty good shape, but as you can see, a drop from 140 to 50, that's a huge drop. That's a drop of about $90 a ton. So that's much more than 25%. So pre-2015, the standard number in the bank is if the break even is about 20%, then you're in good shape. Post 2014, we started relying more on Monte Carlo based simulation. So what that is you assume a model for the commodity price. Now, if you're into financial mathematics, you'd assume that percentage movements in the commodity price follow a certain distribution. You can use typically a log normal distribution, but it's a statistical distribution. And you assume that every day is random. It can either move up or move down. What you'll do is you'll run thousands and thousands of simulations based on long-term characteristics of this commodity price. So what is the long-term average looking like of this commodity price? And you'd assume that the average stays the same over a long period of time. You'd run 1,000 simulations, and those 1,000 simulations, you'd look at the results. So if the simulations tell you that with 90% confidence, the commodity price can range between, let's say, $100 a ton and $120 a ton, and any drop below that is a 10 in 100 year or 1 in 10 year occurrence. That gives you around about 90% confidence that the iron ore price will stay within the range of between $100 and $120 per ton for the next 10 years. You're 90% confident that given a 100-year time space, only 10 of those years the iron ore price would either rise above that bound or sink below that bound. So banks started to do this more and more often, and we would then base our break-even levels based on what the Monte Carlo-based simulations would tell us would be at a reasonable amount of confidence, 1 in 100-year event, a 5 times in 100-year event, etc., etc. We then base our break-even analysis to try and find where this company breaks and compare that breaking point to the 1 in 100-year occurrence, the 5 in 100-year occurrence, etc., etc. So that's what we started doing post 2014. The last thing that we also started to do is you can do the same statistical analysis to find out how long, if the commodity price breaches your 1 in 100-year event, like that really, really low price, how long does it take for the commodity price to rebound? And you can also do that using Monte Carlo-based simulations. So, the purpose of break-even analysis. It helps us to set covenant levels. What is a covenant? A covenant is basically a promise. So you lend money to somebody, and that person says, okay, I promise that I will maintain my debt at a certain level. I'm not going to borrow any more money from the market above this certain level. That's a promise that I make to you. I also promise that my business will be profitable. I'll maintain a 20% EBITDA margin. I will maintain a debt to equity ratio of 5%, etc., etc. I make these promises to you. And the reason why these promises are important is when banks lend money to individuals, what we do is we come up with a rating. And the rating can either range from investment grade, which is anything above triple B rating, depending on which rating scale you use. But let's just assume we're using, I actually don't know which rating agency uses the triple B, but it's for illustrative purposes. When you lent the money to this company, they had a certain rating. The rating tells you what is the probability of this company going bankrupt. What is the probability of this company not being able to repay the debt that you advanced to this company? Okay, so you lend this company money and they have a certain rating. In order for this company to maintain that rating, they need to make you certain promises. So they say that our net debt to EBITDA is currently at 2.5 times, and that's what gave us this rating of BB+. We promise you as a bank that we will maintain our net debt to EBITDA at that ratio for the duration of the loan facilities. If it drops below that, then our rating will suffer. And then the bank, remember your bank charges you interest based on your individual risk as a client. The bank then sees a mismatch. Okay, this company now no longer has a net debt to EBITDA of 2.5 times. It's now 5 times net debt to EBITDA. Which means that rating-wise, for a mining company, it's no longer BB+. It's now sunken severely. Maybe it's B-, okay, on the brink of being really low. It's already sub-investment grade, but really low, risky company. But we're charging this company an all-in margin of, say, 5% per annum. Now, the company's rating now is so low that we should be charging them 7%, 8%, 9% per annum, okay? So it's no longer that the risk is commensurate with the return that we're making on this debt as a bank. So what happens then is the bank would then approach the borrower and say, you promised us to maintain a net debt to EBITDA of 2.5 times. But your net debt to EBITDA is now 5 times. It's worse. It's deteriorated. What we need to do now is we need to sit down and discuss what we're going to do about this. There are many things that you can do about it. You can call an event of default, and you can then call an acceleration event, which means that you say to this company, pay us the full value of the debt back today. Okay. Now, if it's a big company and you've got $1 billion facility outstanding, you tell this company, I want my $1 billion today. Okay. It's unlikely that they're going to have that money on hand. What you could also do is you could tell this company, okay, the current margin on the debt is 5% above LIBOR. Because you're in an event of default, you've defaulted on this covenant, we're going to charge you an extra 2% on your loan. So now the pricing of your loan is now LIBOR plus 7% as opposed to LIBOR plus 5% before. Okay? So what the bank is trying to do now, it's trying to rebalance the risk, which is now high, with the return. So we're asking for a higher return in order to match the now enhanced risk of this company. However, you also have to realize that now that we're charging this company more interest, it's putting the company in an even more risky situation because the company has got less cash retained because it now has to pay more interest on its debt. So it's actually shooting yourself in the foot if you're a bank to do this. So there is actually no perfect solution. Okay, if you do decide, and what often happens is banks tend to be more accommodating than, say, bondholders. So you've bought a bond on the market, and bondholders typically ask for certain covenants. And it's very difficult to negotiate with bondholders because there could be 10,000 people who hold a bond in your company. Okay? Bear in mind, remember that when I subscribe for a bond, I give the company money, and the company gives me a piece of paper that says a bond. It has a face value, and the company must pay me a coupon, which is like an interest payment, periodically. Okay? So if that company has done that for 10,000 bond holders, how are you going to get 10,000 bondholders around a table to negotiate with this company when this company is slowly falling down a slippery slope? What tends to happen is these negotiations don't happen, and the bondholders call the bonds. In other words, they say, we want our money back today. Okay? So it's a lot easier to deal with banks because you'd probably have a relationship with these banks, and you'll probably have 2 or 3 primary banks that are lending you money. And then you can sit down and say, yes, we are having some problems, but it's a temporary issue. Please allow us some forbearance, or we can do the following. We can give you some equity in our company. We can issue some warrants. A warrant is just, it's basically the company will issue you shares at a certain price. If the share price crosses that price, then you can exercise. It's like an option, but the company is actually issuing more shares. So the company will issue shares to compensate you for this additional risk, because now the risk of your debt is no longer debt risk. It's now equity risk. So you can sit around a table and discuss this. And this is what I spent the last few years of my investment banking career doing, sitting around a table and negotiating how these companies are going to make the world better for everybody concerned. So these are quite difficult discussions, and there's no one-size-fits-all approach, and there are a lot of things that you need to consider, including, by the way, reputational issues. It's not actually very easy for the bank to pull a plug and say, okay, you can't pay us the debt now, so we have to liquidate your assets. We have to auction off your assets and recover what we can recover. Because banks often will suffer a huge reputational problem if they do that, because the banks will be seen as profiting from the misfortunes of a lot of people. And there are a lot of theories in the world today that say that in an economic crisis such as the one that we're going into right now, only the banks will benefit. I don't know how much I feel, how much I agree with that statement. Personal experience is the banks don't want to hold assets. We're not like insurance companies. Our investment horizon is a lot shorter, so we don't really stand much to gain by repossessing a lot of assets and sitting on them until markets improve and then selling them. I mean, there's some banks that have done well by doing that, but it wasn't by design. Banks have got a shorter term capital horizon because, bear in mind, people are depositing money short term, and banks are also raising funds on a shorter term basis. So banks want to try and churn the book, try and make those interest, make those deals to get that interest income, and you want to be profitable consistently. You don't want to repossess a bunch of assets, hold on to them, and then maybe in 10, 20 years time, then you make a big windfall. It's not really in the business model of banks to do that. So I don't know how much I feel about that theory. I think everybody, including banks that are in the lending space, do suffer when it comes to economic crises. So just going back to the point, break-even analysis helps us to set covenant levels. So if we have a company and the current gold price, to use a gold company as an example again, the current gold price is $2,000 an ounce. And this company has got a net debt to EBITDA. At that gold price, they've got a net debt to EBITDA of 1 times. The company is doing very, very well. what we can say, if this company breaks even at a gold price of $1,500 an ounce, okay, that's their break-even point. A gold price below $1,500 an ounce, and this company will be loss-making. What we can do as lenders is we can say this company needs to put a covenant in place such that their net debt to EBITDA, okay, let's assume that at a gold price of $1,500 an ounce, where they break even, their net debt to EBITDA will be 2.5 times. What we can do to give ourselves a little bit more headroom is we can tell this company we want a net debt to EBITDA of 2 times. Okay, just to recap, the current gold price, $2,000 an ounce, the company is doing very well. They've got a net debt to EBITDA of 1. At a break-even point, this company breaks even at a $1,500 an ounce gold price. At that break-even point, their net debt to EBITDA will be 2.5 times. Okay, so between a net debt to EBITDA of 1 and a net debt to EBITDA of 2.5 times, what that translates into is it translates into a gold price of between $2,000, which gives them the net debt to EBITDA of 1, and a gold price of $1,500 an ounce, which gives them a net debt to EBITDA of 2.5 times. So somewhere in the middle, this company can play and they'll still be profit making. We want to set our covenant somewhere in the middle there, such that we still have an early warning mechanism. So we'll set our covenant such that our covenant triggers when the net debt to EBITDA is, say, 2 times. Okay, they're currently at 1. We'll set our covenant somewhere in the middle where at this net debt to EBITDA of 2 times, the covenant will breach, and it'll still give us as banks an early warning mechanism before this company is at its break-even point, which is where net debt to EBITDA is not at 2 times, but it's at 2.5 times, that upper bound. Okay. So I'm just going to pause it. Are there any questions? If you have any questions, you can just unmute, or you can just type in the chat. If you want me to go over that again, I can go over that again. Okay, so we're all good so far. Okay. So our break-even analysis helps us to set our covenant levels. Another benefit of this break-even analysis, we can ask ourselves what percentage of production needs to be hedged in order to give lenders comfort. Okay, so hedging, when you hedge something, is like the word suggests. You're putting a wall around yourself to protect you from something. Okay, so when you're hedging commodity price decreases, what you would then do is you would enter into an agreement that fixes the commodity price that you will achieve for a certain period of time. So this gold mining company, gold is currently at $2,000 an ounce. This company will say, well, I predict, actually gold has dropped. I think it's 1,800 today. This gold mining company thinks that, okay, it's going to drop even further in the future. Let me fix it at 1,800. So they've hedged themselves. Okay, they will say that they'll either enter into this hedge with a futures exchange, or they will enter into this hedge with a bank, and they will say to the bank, I will deliver a certain amount of gold ounces, and you need to pay me $1,800 for my gold ounces for the next 6 months, say. Okay, so when this company hedges those gold ounces, and let's say the company fixes those gold ounces at $1,800 an ounce, if the gold price drops dramatically, let's say the gold price drops to $1,000 an ounce, the ounces that are hedged by this company, the company will still get $1,800 per ounce for those ounces that are hedged. For the unhedged ounces, the company is going to get the market price, which is $1,000 an ounce. So in an environment where commodity prices are starting to fall, companies that are hedged have an additional margin of safety because they're still getting the higher prices. Okay, so us as lenders, we will run these break evens, And we will see that, you know what, this is a little bit shady. This company, if commodity prices drop 10%, this company's finished. So we will ask the company then, you need to hedge a quarter of your production until you manage to cut your costs. Okay. So the company then hedges at 25% of its production. And then you run the model again, and then you see that at 25% hedging, the break-even price improves from, let's say, a 10% break-even. It's now at 20% break-even. And we'll do a quick example to see how that works after this slide. Okay. So another purpose of your break-even analysis is it answers this question: do the lenders require other structural risk mitigation tools? So lenders would typically use hedging, but there are also a lot of other things in the debt space that you can do to ensure that your borrower is a lot safer or a lot lower risk for you as a lender. Okay? You can do what are called cost overrun facilities. So whether you're a property developer, whether you're a mining company, in South Africa's case, we've got power utilities that embark on these huge projects. And unfortunately, sometimes, many times, especially in developing countries, there will be cost overruns. So the projects are not completed on time and they're not completed on budget. So in the case of energy companies, they're government owned, so the government can just raise taxes, tax its population, or print money to cover that deficit. However, if it's like a mine, a privately owned mine, unfortunately, if you don't meet your targets and if you overspend, there are a limited number of people who will bail you out. So what lenders typically ask for are what's called cost overrun facilities. If you exceed your budget, you need to have a safety margin in the bank such that if you exceed your budget, you can draw from that facility to cover any times where you exceed that budget. Okay, so those are cost overrun facilities. The lenders can also require that you raise more equity relative to the debt that they advance to you. Okay, so I'm going to give you a certain amount of debt, but before I give you that debt, I want to know how much skin you have in the game. How much of your own money have you put into this mining company? Okay, you can't expect me to give you $1 billion and you haven't put anything in, especially if it's a high risk mining project. If I foot you $1 billion, I would ask for a debt to equity ratio or a gearing ratio, which is just, it's the proportion of your balance sheet which is made up of debt versus made up of equity. So let's say I give you $1 billion and I want a 50-50 gearing ratio. That means I want you to put in $1 billion of equity and I will put in $1 billion of debt, such that the ratio of the debt raised and the equity raised is 50-50. Okay. If it's a lower risk mining project, maybe we can push that to 60-40 or even 70-30, where I will give you 70% of the project in the form of debt and you just have to give me 30% as equity. And there are many ways to de-risk the project such that you can push the debt up a bit, and we'll touch on those just a little bit later. Okay. Another thing that we can look at are parent guarantees. So if you have a mining company and it's a project company, basically it's got no assets and they just want to dig for gold in foreign jurisdiction. That's very high risk, because as a bank, you'll be lending to this project company and effectively all they have is just a hole in the ground. Okay, but you're giving them billions of dollars and you're relying on what's in that ground to repay you. It's very high risk. What you can do is you can say, if this project company is part of a larger group of companies. So in other words, if Anglo Gold wants to launch a new gold mine in Papua New Guinea, okay, you can say to Anglo Gold, fine, I will lend money to this project, but if the project fails, I want you as Anglo Gold, which is a huge multinational company, I want you to guarantee that debt such that if that project cannot pay the debt back in full, I can call on the guarantee that I have with you and you will make me whole. You will pay the contractual capital and interest out of the Anglo consolidated balance sheet, as opposed to me hunting down that individual small little project company in Papua New Guinea. Okay. So with the parent guarantee, you can push that gearing ratio to 100%. You can give them 100% debt because you know that Anglo stands behind you and Anglo is worth hundreds of billions of dollars. Okay. Another structural risk mitigation tool is a cash sweep, and we touched on this and we did an example of this in the previous episode. I encourage you to check it out on YouTube. It's got timestamps in the video where it shows the worked example that I did explaining how a cash sweep works. But just to quickly touch on that, a cash sweep is an agreement whereby you say to a borrower, whatever money you've made in the year, after you've paid all of your bills, I'm going to take 25%, 30%, 50% of the money that's left over in your account, and I'm going to use it to repay my debt. So I'm going to sweep the account and take a certain percentage to repay my debt. So it's not contractual. I can't predict what that amount of money is going to be exactly in the future, but I've just got a standing agreement that I'm entitled to 25% or 33% of that money. Whatever money is left over after you paid all your bills, I'm going to take 25%, and that's what's called a cash sweep. So all of these things, a cash sweep helps reduce risk. A cash sweep is almost like hedging, because when times are good, this company is going to be generating a lot of cash, and the cash is just going to build up. And then what you can then say as banks, when times are good, I'm going to sweep that cash and I'm going to repay my facility. Okay. And when times are bad, because you've taken money out when times are good, this company doesn't have as high debt or as high gearing. So it has de-risked in a way. Okay. So cash sweeps is almost like hedging the commodity price, but in a different way. Oftentimes, mining companies hate hedging because if you hedge the price of the commodity, you fix it. So it means that if you fixed gold at $1,800, what happens when it goes back up to $2,000? Okay, that company's given up $200 of upside by fixing the price, and that's why management is often reluctant to hedge in practice. Okay, so maybe they'll be more amenable to a cash sweep instead of a hedge. So the next purpose of a break-even analysis, if you look at the break-even prices, okay, so going back to this gold mining company, if the company's only got 10% wiggle room, maybe you look at that and you say, is this risk senior debt? Maybe it's not senior debt risk, maybe it's mezzanine risk or equity risk. So in the spectrum of risk, senior debt is the least risky because those are the lenders that typically take security, they take collateral, and they get paid first out of the cash flows, operational cash flows of your business. They get paid first. Your mezzanine lenders only get paid after your senior lenders get paid. So they're next in the ladder, and then equity gets paid last. So it goes down in order of risk. So senior debt is the least risky, mezzanine more risky, and equity risk the most risky. So you can then look at this company, you look at their break-evens and you say, this is not senior debt risk, it's very risky. So this business is more akin to equity risk, and that's what your break-evens will tell you. Okay. Some follow-up questions after you've determined the break-even point of this company. You can ask the company, what is their market share? Okay. Are they a dominant player in the industry, or are they a small player? You can determine what the company's position on the cost curve is and what the company's cost structure is. Do they have high fixed costs or high flexibility? Okay. So just looking at a cost curve, this is a cost curve. And what a cost curve does is it orders all of the producers in the industry from lowest cost all the way to highest cost. And it's like a histogram. So the area or the width corresponds to the actual production volume of each of these companies. Okay, so you get a narrow bar here, which means that Barberton Mines does not produce that many ounces, but contrasted to Kloof and Driefontein, which are high producing companies, and you can then see the width of each bar corresponds to the production and the height corresponds to the cost of production. So it then goes to reason that you want to lend to companies that are on the left-hand side of the cost curve. Why? Because companies on the right-hand side are high-cost producers. If the gold price drops significantly, guess who's going to go out of business first? The companies on the right of the cost curve. Okay, so that's why you want to lend to companies towards the left-hand side of the cost curve. So if your break-even analysis shows that this company prices can decrease 15% before this company goes out of business, then you ask yourself, okay, where is this company on the cost curve? If this company was Sibanye, and if Sibanye only had Kloof and Driefontein, these are Sibanye mines, then if their margin of error is 15%, I can then take a view that says that the gold price is unlikely to drop 15%, because if it does, all of these companies are going to go out of business before Kloof and Driefontein. Okay, so it's very important to look at your break-evens in the context of the cost curve as well. If your break-even is, say, 40%, which seems on the surface very robust, but you are lending to South Deep, wow, even at 40% margin of error, I will ask you to hedge a hell of a lot. Not too much, because that could also bankrupt a company if they hedge too much, and we'll touch on that a bit later. But I would ask you to hedge a lot in order to maintain those margins throughout the life of my debt. So I would look at South Deep a lot differently to the way I look at Kloof or Driefontein. Okay. And what is the company's cost structure? High fixed cost or high flexibility? If a company has got high fixed costs, it means that the company will incur those costs no matter what. Okay, fixed costs are going to be incurred no matter what. So typically salaries can be thought of as fixed costs, because whether or not you produce 100 ounces today, or that's very small. Let's say you produce 1 million ounces or 2 million ounces, your wage bill, you still have to pay these people salaries. Okay, so for instance, COVID-19, many people had to stay at home, but they still had to have their salaries paid. Okay, so those are fixed costs. However, if the business has low fixed costs, so let's say the business has a lot of variable costs such as fuel or electricity, even when the COVID lockdowns hit the first time, what you'd see is, even though nobody could produce anything, your costs went down dramatically. So in a way, those companies fared a lot better than companies that had to keep the mills going, had to keep the plant going, had to keep the pumps going to pump out the water from the mine shafts. Those are all fixed costs. You're going to have to do that whether or not you're producing. So companies with high fixed costs have lower flexibility. And I'd also look at that when I look at my break-even analysis, to see what operational flexibility this company would have to cut its production if it needed to do so in a low price environment. Okay, so let's do some examples. There are two main methods used to calculate break-evens. You can do a cumulative break-even. Okay, a cumulative break-even is where you ask yourself, if prices stay like this for the long term, how long can we last as a business? Okay, bad times. And if they persist for the long term, how much longer do we have as a business? So you're going to take the commodity prices well into the future and you're going to drop them for a long-term period. Now, a cumulative break-even is good for long-term scenario planning. How long can we survive in a low commodity price environment? It's also useful for companies with cash lockup provisions and retained cash balances. Okay? So, if you have a business that can't pay dividends, this is typically the case of a startup that has borrowed money from a bank, and the bank says that until you pay us our debt back, you're not going to pay anybody dividends. Okay, so there's a cash lockup provision there. They have to keep whatever excess cash there is in the business until all the debt is repaid, and then they can pay dividends out. So in a scenario like that, you can get a business that has got a lot of retained cash, but it's going through a tough time. If you as a lender have stipulated that this company is not allowed to pay out dividends, what you can then do is you can rely on that retained cash, because you know it's going to sit there. You can rely on that retained cash to see the business through the difficult times. And then you do this long-term break even to see how long do we have, what is the cash burn rate, okay? How long can we last until the cash runs out? It's also useful for companies with bonds and revolving credit facilities with no contractual amortization profile. So if you have a company that is funded by bonds, it's issued bonds and bonds are repaid via a bullet, okay? So you repay the capital right at the end. Then, if that capital is only due in 5 years' time, you need to think long term, okay? So you need to think to yourself, if commodity prices remain weak for the next 5 years, can I repay that bullet? And that's when these cumulative break-evens or long-term break-evens are quite useful. And what I'm going to do is I'm just going to do that example with you. I'm just going to do it from scratch just to illustrate it. We have a copper mining company here, and this company is domiciled in South Africa. It's called ABC Mining, and it has just raised project debt. I think it's raised about $1.5 billion of debt. And me as a lender, or the company wishes to raise the debt, I as a lender want to calculate if it is a good idea to give this company $1 billion worth of debt. Okay. So what I need to do is I need to run some scenarios in the model. Let's do a break-even scenario. So let's see what the long-term copper price can fall by in order for this company to still remain break-even over the long term. I'm going to go to my model. I'm going to look at my financial summary. And the financial summary starts all the way from revenue, operating costs, EBITDA, all the way to your cash flow available for debt. So this is the amount of money that I borrow. It's these debt drawdowns. This is senior debt and that's mezzanine debt. And I need to repay this debt in 2023, 2024, and 2025. So I have a 2-year capital grace where I don't have to pay any capital. And then I have to repay my debt. And these are my resultant cash flows. My closing cash balance starts to build up over time. But that's assuming that my copper price is going to behave in that way. What happens if my copper price in the long term drops? So I go through a period or long-term scenario with a depressed copper price. Okay. What I want to do is I want to find out whether this business will be able to repay all of this debt. So my senior debt is repaid in 2025. Okay. And I want to find out what the minimum copper price is that allows all of this debt to be repaid in 2025. Now, I've stipulated that this company cannot pay dividends until it's repaid all of my debt. So it's got a cash lockup there. Okay. So whether this company makes a loss in certain years, as long as this company has got a positive cash balance or at least zero cash balance and my debt is extinguished in year 5, then I'm happy. Whatever happens after that, it's their business. So I need to find the minimum copper price, long-term copper price, that this company can achieve such that they just pay back my debt out of either operational cash flows or retained cash balances. So what I can then do is I can go to my summary tab, and we show you how to build a model like this in full from scratch in my financial modeling course. But for the purpose of this webinar, just assume that you built this model, it's fully functional, you understand how it works. What we can then do is we can say minimum cash balance. And the minimum cash balance over the period of our debt, okay, is this closing cash balance number up until 2025 when all of the debt is repaid. Okay, so that's my minimum cash balance. What's actually more important is if I change this formula and I focus on the years where they will be paying the debt back, because bear in mind, this company, they start off in 2021 and they're not making any cash because they're still building this mine. So I think to be a lot cleverer, it would be better to do this analysis for the period when they are actually generating cash and repaying my debt. So I'm rather going to take the minimum of these 3 years here where they stop drawing down on my debt and they actually start generating cash to repay my debt. Okay, so rather do that. I'm going to use a goal seek function. Let me just show you what we're doing. This copper price stress runs through my economic assumptions. These are my assumptions for what the copper price is going to do over time. And this copper price stress, if I say 90%, it's going to reduce all of these prices here by 10%. Okay? So I can do that iteratively. I can try and solve for a minimum cash balance of 0 by saying 85%. Okay, that's too much. 87%. Okay, I can do it iteratively. Or I can do a shortcut. I can just do a goal seek. So goal seek, you can find under data, what if analysis, goal seek. Remember, this is the minimum cash balance over the years 2023, 2024, and 2025. I want this minimum cash balance to be 0. Okay? And the thing that's going to change my minimum cash balance is my copper price. Okay, that's close to 0. So I see that my copper price can drop by 12% from consensus analysis or consensus view. Okay, can drop 12% over a period of 5 years. So it's going to drop from 2021 all the way up until 2025. Okay, and at that point, this is the minimum copper price that this company needs to achieve in the long run, such that they're able to repay the debt. Okay, and they can repay it via retained cash balances or operational cash flow, but they just break even and they just repay my debt. So they have a 0 cash balance at the end of 2025. Okay. So let's see something interesting. This company is currently unhedged. Okay, they hedge 0% of their production. Let's see what would happen if we as banks, we say 12%, it's a little bit tight. I'm not comfortable lending where the long-term margin of error is only 12%. What I'm going to ask you guys to do is when you guys start producing, let's say for these years, 2023, 2024, and 2025, I'm going to ask you to hedge 25% of your production for those 3 years. Okay? You can leave 75% of your production unhedged, but 25% of your production has to be locked in at the forward curve. Okay? So let's do that break-even analysis again. We will go data, goal seek. Okay, we want a minimum cash balance. Remember before the margin of error was 12%. We want to set our minimum cash balance to 0 by changing that sensitivity factor. Okay, so it's gotten a little bit more robust. So now it's 16% headroom that the company has. So now you'd have to, as a deal maker, you'd have to think, okay, we can probably push the company to hedge maximum 30%. What other structural mitigants can we ask the company for? And those are the things that we saw earlier. Maybe we can ask them for more equity, a cost overrun facility, some parent guarantees, cash sweep, etc., etc. So that's how you'd go about structuring a deal with a client, and it would be a give or take. You'd go back and forth, and you'd have to sit for days, maybe sometimes weeks, negotiating this with the client. But this just illustrates that, generally speaking, if you manage to hedge at good prices, it makes the project more robust. So I'm just going to set that back to 100%, and I'm just going to undo the hedging that we put in place there. So that's a long-term break even. You also have a per period break even. So this is useful for modeling black swan type events. Okay, these are sometimes short-term events, such like a September 11th terrorist attack, something that affects the market in a very drastic way in 1 year, but the following year there's a recovery and everything goes back to business as usual. I don't know so much if you can class COVID-19 in that category, but let's assume that September 11th is a good example. So what you're going to do is you're going to look at your model and you're going to stress each individual year in isolation. You're going to leave all previous years the same. So you're going to assume life as normal, and then what if a black swan event happened in year 1? Okay, then you're going to do it again. Assume life happened as per normal in year 1, and then what if a black swan event happened in year 2? And you're going to do it again. Assume life happened as per normal in year 1 and year 2. What if the black swan event happened in year 3? So you're going to do it per year and leave all previous years at base case or at normal assumptions. It's also useful for companies that pay dividends, because unlike our example before, which had a cash lockup, if this company is entitled to pay dividends, you need to assume the worst, especially if you are a bank that's on the debt side, you're lending. So you need to assume that after they pay your capital and interest, all of the money goes out of the company in the form of dividends. You assume the worst because you have no share in the upside, but we'll touch on that maybe in a future webinar. So if a company pays dividends every year, you start off on the assumption that you're going to do the break even up until, let's say, they meet a covenant, and they can take out all cash from previous years. So you're going to do it isolated, period by period, to make sure this is the minimum price that they need to ensure profitability. So I'm going to show you how that works now. Let's look at this model that we have. We have this mining company, and we've done in-depth analysis in our model. We've got a total cost breakdown of this mine. 54% of the costs are, we can see those are plant variable costs, and 41% of the total cost of this mine are mining variable cost. So let's break that down further. If we look at the plant variable cost here, a majority of the plant variable cost comes in the form of smelting and refining costs. Okay, so remember, our break-even analysis, we can either do the break-even on the revenue side, we stress the revenues down, okay, the revenue drivers, or we can stress the cost drivers up. We can inflate costs and find out where the company breaks. Okay, so let's look at one particular cost, which is quite a material one. It's your smelting and refining costs. These costs represent about 60% of your plant variable cost, which represent about 50% of your total costs. So they're about 30% of the total mining costs come from the smelting and refining costs. Okay, so that's typically what you do is you crush the copper and then you put all sorts of chemical substances in it that dilute the actual copper, and they put the copper in a liquid form, and then you then do you'd pass it through some sort of a electrolysis circuit where the copper would then be plated on a plate that's been magnetically charged, and then you then melt that through in a furnace to remove even more impurities, but that's very expensive. So about 30% of your costs come from that process. So yeah, the plant variable cost is about 30% of your total cost. And what you can then do is you can look at how that cost is, how material that cost is to the overall business itself. Okay, so let's do that. Let's perform a stress where we inflate our smelting and our refining costs to the point where the business breaks. Okay, and we'll do it on a per period basis. So to do that, we go to our plant assumptions tab. And we see that our plant assumptions, these are all the variable costs here, and we have our smelting and refining costs there. Okay. What I'm going to do is I'm going to build in stress factors here. Just call that 100% there, and then drag that across. And then I'll just put the sensitivity factors. Okay. And what I'm going to do is I'm just going to link it to the actual costs above there. Okay. So what I can stress now is let's stress a covenant breach. So there's a very widely used covenant in mining and project financing called the debt service cover ratio. And basically what your debt service cover ratio measures is it measures the amount of buffer that your cash flow after you've paid all your salaries and all your indirect and direct costs. You call that cash flow available for debt service. Okay, that's the cash flow that's available for you to pay your capital and interest for that period. So the ratio of that cash flow available for debt service to the actual debt service, the actual amount of capital and interest that you need to pay, is called your debt service cover ratio. So I have calculated my DSCR, or debt service cover ratios, in the past, and I have put those in my financial statements or financial summary tab. And there we go. 2022. Just do that again. Okay. What I want to do is I want to do my break-even analysis on a per period basis. Okay. So my debt service cover ratio at 1.5 times, it means that there's a 50% buffer. My cash flow exceeds the amount of debt service I have in that period by 50%. So I've got a 50% buffer. Now, I want to know how high my refining costs can rise in that period. Okay. Let's say a supplier goes out of business, a major supplier in the industry goes out of business. So the supply goes down in the industry and demand stays the same. So then the price goes drastically up. So how much can my refining costs rise until the company breaks? Okay. So I'm going to say, let's say I set my covenant at a 1.25 times debt service cover ratio. I will again go to Gold Seek. I will say I want to set my debt service cover ratio to 1.25, and I want to change my smelting and refining costs according to this sensitivity factor. Okay. So what I find is that my smelting and refining costs can rise by 43%. Okay. And if they rise by 43%, then I will trigger that covenant breach. Okay. And I can then do it for the next period. I'm just going to save this result here. I'll just call that headroom. And I'm going to set that back to 100. So again, we do this on a per period basis. So we assume that all prior periods behave according to normal, and then we have the black swan event in that particular year. So let's assume we have the black swan event in 2024. Okay, I'm going to set my debt service cover ratio to 1.25 times. And again, I'm going to change my sensitivity factor. What this tells me is my refining costs can rise by 50% before I breach this covenant. Okay, so the business is looking pretty robust from the cost side of things. Okay, to get a 50% rise in costs in 1 year seems a little bit like it's going to be a real black swan event. In other words, it's really going to affect many other businesses in the economy, and it's something that you can really seldom hedge out of the equation. So I'm happy with these break evens, 43% in that year and 51% of this year, and we can carry on the analysis for the subsequent 2 years and or subsequent 1 year, because it's a 5-year facility, and that's how we do a per period stress. So I will just remove that. Okay, I remove this. These two. Okay. So going back. Okay. So that covered the section on break evens. We now go to another question that was asked in last week's webinar. What's a good due diligence checklist, or how do we do effective due diligence in the mining industry? So we covered these extensively in the mining finance course, and there's an entire chapter devoted to how you mitigate various risks, whether it's in mining corporates or in project companies. And I'm just going to run through some of that chapter with you now. So some of the main risks that you'll come across when you're doing mining, whether you are launching a new mining venture, you are at project phase, so it's a new venture, or whether you are an established corporate, I just bundle these risks together, and some of them are more relevant to projects and some of them are more relevant to corporates. And let's run through them and see what we come up with. Okay, resource and reserve risk. So mining companies, they have ore in the ground, and then you'd have a preliminary feasibility study, and then you would declare what's called resources. So you haven't done a lot of financial modeling on your deposit. You just know that this is the gold or copper that I have, and these are the grades that are in the ground. Okay, you don't know whether or not it's economically feasible to extract that gold or copper. Okay, so the difference between resources and reserves is, for resource, you know that the copper is there, you know what grade it is, but you don't know whether or not it's you don't know whether it's economically viable for you to actually extract that copper. Okay, so reserves are when you have done that work and you do have somewhat of a financial model, and you estimate that, okay, it'll cost me $5,000 a ton to remove this copper, and copper prices are now at $6,000, so it's economical for me to remove this copper. But as I go deeper into my pit, it costs $7,000 a ton to remove the deeper copper. So I hope you can then appreciate that all of the copper would potentially be in the reserve category, but only the percentage that can be mined at a cutoff price of, let's say, $6,000 or $5,000 a ton. Only the copper that can be mined at a certain price would be included in your reserves. And as you vary that cutoff price, your reserves can either shrink or increase, but the actual copper in the ground is more your resource. Okay. So resource and reserve risk is the risk that the recovered ore in an ore body is materially lower in quantity and quality than what was initially anticipated. Okay, very bad. I was watching a very interesting interview now, especially when gold is the hot topic, where quite a prominent investor in the gold mining space says the number one attributable reason for failure of these junior gold miners is that they've overstated their reserves. They haven't done sufficient drilling. They're too optimistic. So this is a very real risk in the mining industry. Just got some notes here. So resource and reserve risks, the best way to mitigate that is to make sure that your resources and reserves are declared using industry codes. So in South Africa, we have codes that are called SAMREC. You also have international codes called JORC and NI 43101. So these codes are just best practice codes that stipulate how you need to do your drilling, the spacing, and just to find a standardized way in the industry to get people to do the exploration work. Okay, if certain people in the industry are cutting corners and other people are doing more stringent evaluation of the actual ore that's in the ground, that's not good. How do you compare apples with apples? The best thing for you to do is to find some sort of a code that standardizes the methodology, and then when you say when you see two company prospectuses and you see one company with a resource or reserve that's one size and another one with a resource or reserve that's another size, you know that you can compare apples with apples because they've both followed an industry code which is regulated. Okay, so that's the first mitigant there. You also need to check who did the resource and reserve statement and who did the drilling. So who was the competent person? Did they hire a reputable consulting company or exploration company to do that? You can also look at the geologist in the actual mine in question. Do they have sufficient technical expertise and experience? And you can look at that. In the debt space, what we do is we only lend against reserves. So in senior debt in the banking space, you would not place any value on the resources when you are assessing whether or not this company has got sufficient debt capacity. You only look at the reserves. Why? Because the reserves have been estimated using economic considerations. Okay? And there's been a lot more effort put into proving up the reserves, a lot more effort determining whether or not this ore can actually be extracted and can actually be monetized with a reserve versus with a resource. Okay, so for that reason, because there's a higher confidence in your reserves or a higher confidence with you actually monetizing your reserves, mining companies in the debt space tend to lend against reserves and not resources in the debt space. You do get some players which play in the higher risk spectrum, which may value resources, but in the senior debt space at least, you only look at the reserves. You'd also need to look at the nature of the ore body. Okay, basically the same interview. A senior geologist was saying that he places much more confidence on what they call complexes. So you'll have a deposit that sits in the middle of a huge complex where there are other similar occurring deposits that have probably been mined previously. And what you'll find is the geological characteristics in that complex are quite similar. Okay, so this greatly enhances your confidence as a funder in the mining space. If you know that there is a deposit right next door, the one that you're trying to fund, and you know that it's been mined for 50 years and it has these characteristics, and there's another deposit not too far away, you can generally form a view of the mineralization of the entire region. And you can call it a complex because there's certain ore deposits that are scattered in this complex that have similar characteristics. So if you are lending to a project company that is within a mineralization complex that has previously been mined and previously shown to be profitable, this is very good, and it's a very good risk mitigant as well. The next risk that we have is construction risk. Okay. The construction of a project is not completed or is completed to suboptimal quality. And again, this is another interesting thing that very seldom in my career have I seen a company that comes in on time and on budget. I have seen it, but it's like an anomaly. It's rather the exception rather than the rule. So what I have seen is companies do experience delays and do experience overruns, and this is quite risky. So there are certain ways to mitigate this, and what we have here is your contractors and your management team, very important. So when you are building a mine, maybe you are hiring contractors to do certain aspects of the construction. Okay. Those constructors need to be reputable, and where possible they need to offer you completion guarantees where they are liable to pay damages, or there's some incentive to make sure, maybe they're incentivized, they get bonuses to complete on time. There's some incentive to make sure that they complete the project on time and on budget so that everybody's interests are aligned. So looking at the management team and looking at the constructors is of great importance here. Obviously, the more experienced the management team, the better they're able to project manage everybody and bring everybody together to ensure that the project is completed on time and on budget. Okay. Another one there is a drawdowns contingent on milestones. This is also very important. If you have a debt facility in place, and it's not a bond, so let's say it's bank debt, what you typically do is you'd say that I'm not going to give you all of the money up front. I want you to meet certain milestones along the way, and every time you meet a milestone, you can draw down funds on this facility. So that makes sure that not all of the money leaves the bank on day one, okay? Such that you are managing your risk as you go along as a bank. So if the company runs into difficulties, maybe they've only drawn down 20% of your facility, and if it's due to incompetence, you can tell them, well, I can't advance further funds to you. You need to get your equity holders to stump up some equity, and then maybe we can do it on a 50-50 basis, and then the facility goes on as per normal once you sort out this hiccup that you're going through. So you can do that if you have these staggered drawdown profiles based on milestones. Okay. Another thing is cost overrun facilities, as we mentioned before. And also when you're doing your financial modeling, you also need to build in certain contingencies. So it's very good for you to get estimates of the capital expenditure that you are required to spend, so you know what equipment you're going to import. But build in some contingencies, because what happens if the exchange rates moves in a way that's not in your favor? What happens if suddenly, like a COVID scenario where it's very difficult to import the parts and you have to maybe pay extra to get the parts imported in the harbor, they have to sanitize everything, I don't know, maybe there are additional costs to importing the goods and services that you need in order to construct the mine. So if you build in contingencies, this will give you a safety buffer. Okay. The next risk we have is operational risk. Now this is related to mechanical or human error, which may arise in mining, processing, or the shipping of ore, leading to underperformance. And I guess this all just boils down to the team that you have on site. That's probably the greatest mitigant that you have there. Making sure that the right people are on site running the mine. Another thing that I've got is banks generally prefer simple mining methods and proven technology. Okay, this is very important because I would much rather lend to a project that's using stock standard mining techniques or low risk mining techniques. For example, an open cast mine where you're opening a pit and you're not drilling a hole deep underground and doing underground mining. There are a lot more complexities in underground mining as opposed to open pit mining. So it's a lot simpler to mine in a pit, and then you look at the processing. What's the mineralization? What are the impurities in the rock? Is it just a stock standard? You just leach the stuff and you just dissolve the mineral that you want and then send it through your processing plant, melt it down? Or is it something that's a lot more complex where you need to process the ore in many different ways before you can extract what ore you need to extract or what mineralization you need to extract? So we tend to look for simple mining and simple processing methods, and this is seen as a very good risk mitigation tool. You can even look at reputable suppliers with good after-sales and warranty options, completion guarantees, completion tests. This is quite important as well. If you are lending as part of a project financing, what you want is you want to make sure that generally speaking, let's say you're lending to a project that has a parent guarantee. Now, this parent company, going back to our example before, there's a mine in Papua New Guinea and the parent is AngloGold. AngloGold wants to be released from that guarantee as soon as possible because it's an extra liability on their balance sheet. Okay? So you will say to Anglo, we will release you from the guarantee. In other words, we will look to this Papua New Guinean asset only, okay, once this asset is constructed and once it is producing at steady state production. Now the devil is in the details. How do you define completion? Okay. How do you define steady state production? You need to make sure your completion tests are pretty robust because if the company passes the completion test for 6 months and then runs into some teething problems, you've released Anglo from the completion test, and then the project runs into problems and you are uncovered by the guarantee now. So you need to make sure that your completion tests are designed with competent engineers, and they are quite comprehensive to make sure that this mine is running efficiently and is running optimally before you release the parent from the guarantee. Okay. What else have we got for operational risk? Oh, okay. You need to make sure that you study the operational history of the mine and the management team. Is the mine prone to strike action? How has the management team handled that in the past? Is the mine prone to technical failures and malfunctions of equipment? This is a very big one. How has the management team managed that in the past? Okay. And the last one is insurance policies in place. You need to make sure that the mine has adequate insurance policies in place such that if something breaks down on site, they are in fact insured, and whatever has broken down can be repaired very quickly and is adequately covered. You don't want a scenario where it's uninsured and then they need to raise more funding to fix it, and all in the meantime they're not producing. So you need to make sure you have adequate insurance in place. Okay, I'm just going to pause here and check for any additional questions. Okay, let's continue. Okay, so the next one there is market risk. This is the price volatility, failure to obtain offtake, disruptive technologies, and other macroeconomic or geopolitical factors. This is outside of your control, really, because it has to do with the macroeconomic environment. So when commodity prices crash, it's generally outside of the control of the mining company because it's more on the demand side of things. But what you can do to protect yourself against this is you can have adequate hedging in place. With the failure to obtain offtake, you can have good relationships with your off-takers. You can also have a check to see that the final finished product that this mine produces is of a good quality, is high quality spec, so that there is actual demand for this project, for the product that you will be producing, and it's not, an inferior good that is very easy for off-takers to just say, you know what, we've got a superior product, we're going to substitute that product for your product. So very important that you check the actual quality specifications of what the market demands versus what you actually produce as a company. Okay. Another way to mitigate that is to have commercial risk insurance, where you would, as a bank, you'd lend a company a certain amount of money, but you'd insure a certain portion of that debt. And what you can then say is you can say to the insurer that in the event that the mine fails to be profitable during this certain period of time, we want to take insurance on this debt such that if the mine fails to pay capital and interest, you will pay us for the percentage of the debt that we insure. So it's just an insurance policy on the side of the banks. It's different to the insurance policies we spoke about earlier that covered your operational risk. Okay. Financial risk, this is a big one. Financial risk is the risk of a company's capital structure not being suitable to its balance sheet or cash flow profile. Okay. But it can also get a little bit more technical. Bad covenants, liquidity issues, misaligned lenders, legacy contracts, and facilities causing conflicts. Let's talk about the non-numerical. Let's talk about the qualitative things. Misaligned lenders. And I've got personal experience in this, where you have a mining company where you have two sets of borrowers, or two sets of lenders, and you're in one lending consortium, and you have lenders in another lending consortium. And you're providing different types of facilities. So this is all well and good. Your interests are aligned when the company is doing well. What happens when the company starts to encounter certain periods of difficulties? This is where, as a lending consortium or lending consortia, it's very important to be aligned. Because the last thing that you'd want is to have the lenders fighting amongst themselves when this company is experiencing very difficult times. So, for example, if you have one lender that has granted a company an amortizing facility that is fully drawn, so a group of lenders fully exposed to this company. You have a separate group of lenders that is maybe lending this company a revolving credit facility. Okay, so let's assume this revolving facility is undrawn, and now this company, for some reason, is experiencing some difficulties, and it needs liquidity to tide itself over for the next 6 months. It's good. This company has got an undrawn revolving credit facility. But now let's assume that it's due to an event that you can call a force majeure, a COVID-19, or something, a black swan event. And the lenders that are supplying this revolving credit facility see themselves as being undrawn, so they're not exposed to the risk of this company. However, the lenders that are fully drawn on the amortization facility are fully exposed to the company and are fully at risk. There's a misalignment of interests now, because the lenders who can potentially give this company some more liquidity in the form of the revolving credit facility will say, let's put a draw stop. Let's try and get our lawyers together to try and justify how we can avoid pumping more capital into the struggling company, where the prospects of us getting our money back are a bit unsure. And the lenders that are drawn already are pleading and saying, please just give them this liquidity. They only need it for 6 months and then everything will be okay again. Very difficult to have a conversation around a table when that is the state of affairs. So if all the lenders are aligned, let's say all the lenders were 50-50 in the revolving credit facility and in the amortizing facility in the RCF, it would be a lot easier for them to get around a table and think big picture, think long term, okay? Because they stand equally to gain or equally to lose based on whatever actions they decide to take. So misalignment of lenders is a huge risk in financial consortia or lending consortia. Another risk is where you give a company too much debt. They're overgeared. Okay? This makes the company higher risk in times of low commodity prices. What could happen is this company could find that its interest burden on the debt, interest and capital burden on the debt, is too high. So this company cannot weather the storms of bad times as easy as a company that's got lower gearing. So you need to make sure that your gearing is in line with the financial model that you have for this company. And as well, there's the opposite. If the company does not have enough liquidity, so let's assume that this company has terms on its offtake agreements that its offtakers only pay it after 30 days, and everything's going well, but let's say there's some technical disruption and the offtaker can't pay and they don't have enough working capital facilities, the company's still profitable. Everything's going well, but through some glitch, an offtaker can't pay them in time. And due to that small glitch, the company does not have sufficient working capital to tide them through that problem. So they have insufficient liquidity. That's also a risk there. Structural or contractual subordination. We spoke about that a little bit, but in the previous last week's webinar. Basically, when you're structurally subordinated, let's look at this structure. So we're lending the debt at the project company level. If there are other lenders that are lending at a level above us, but we're both dependent on the cash flows of this project company to pay us, the lenders that are lending here are structurally subordinated. The only way they can extract cash from this company is by means of shareholder loans and dividends. Okay? But we are the senior lenders here, and because we're senior debt, we get paid before all dividends and shareholder loans get paid. Okay? And they can be the senior lenders at the company one step removed. So they're both senior lenders technically, but we are contractually superior to them because we're closer to the cash flows. So they are they are structurally subordinated to us. We are structurally superior to them because we're closer to the cash flows. You can also achieve contractual subordination, but you do that via legal agreements. And we spoke about that earlier when we talked about the senior facilities and the mezzanine facilities. You write in your legal agreements that from all operational cash flows, senior debt gets paid first, followed by mezzanine debt, etc., etc. Okay, so that is contractual subordination. Political risk, that's the government of the host country acting in a prejudicial manner towards the mine or towards the banks, expropriating assets, charging additional tariffs, or even the collapse of the currency where this mine is domiciled. That's also political risk. If the domestic currency collapses and the mine is unable to, say, pay wages for a certain period of time, and they have to close their operations, or it causes rioting on site because of hyperinflation. These are also risks that are tied to political issues. Logistics and infrastructure risk. How are you getting your power? How are you getting your fuel? How are you getting your ore out there? Do you have access to rail, highways, shipping? So those are all those risks there. And these are usually taken care of during your feasibility studies. Environmental risk is you want to make sure that the mine is not located close to any environmentally sensitive areas such as wetlands. There's a very famous investor, his name is Robert Kiyosaki, and he lost a gold mine in China because it was alleged that he had polluted a river. So the government expropriated the mine and carried on running it. So environmental risk can be a major factor, whether or not you can lump that with political risk, because the story is quite complex. One party alleges that there was foul play, the Chinese government, whereas Kiyosaki alleges that it was more political motive to expropriate the mine from him. And there are other risks as well related to the funding of terrorist entities, money laundering, and other sanctioned activities. Banks usually have what's called KYC and other anti-money laundering, anti-tax evading, FATCA requirements that they take care of in-house, just to make sure that everything is above board there. A lot of big banks such as HSBC have been caught in the past, and Deutsche Bank recently, dealing with some dubious entities and individuals, and you just need to do appropriate background checks to ensure that that does not happen to your organization. Okay. So for the last section, we will answer a question that I received in last week's webinar. Levered versus unlevered beta. Okay, so when do you use which? I gave the answer, but I didn't really give it in sufficient detail, so I'm going to expand on it a bit now. Basically, let's go through the slides. I think it's best to do it sequentially. So we have a private company which we wish to value. For those of you who know, who are in the valuation space, beta is just a relative risk measure. So if a company has got a beta of 1, it means that when the general stock market or general economy rises, that individual company moves almost exactly the same as the general economy or general stock market. Okay, use the stock market as a proxy for the economy usually. So a beta of 1 means if the stock market rises by 10% or if the economy improves by 10%, this company, individual company with a beta of 1, will also improve by 10%. And if the stock market drops by 10%, this company's value will also, or returns will drop by 10% as well. So it's perfectly correlated with a beta of 1. And how we estimate beta is we look at the historical returns of the stock market and we compare them with the historical returns of this company, and we do a covariance. Actually, it's a regression line. So you plot on your x-axis, you plot the values for the economy or for the stock market, and on the y-axis, you plot the corresponding values for this individual company, and you connect the x and the y coordinates, and then if you can form a straight line, and the straight line is sloping with a gradient of 1, then it means that this company is perfectly correlated. If it's got a slope of -1, then it means that this company will behave in a way that's completely opposite to what the economy is doing. And if it's just a scatter of points, then it means that this company historically has not really been correlated with the performance of the stock market or the economy. So that's just an introduction to what beta is. So oftentimes, you want to value a unlisted or private company. So when you calculate the beta of a company, you can look at the historical trades and the historical share price movements to do that covariance calculation. Okay, so you can then find that slope of your regression line very easily if the company is listed. If it's unlisted, you're going to have a little bit of a problem because you don't have those historical share price movements. The shares are illiquid, so you only buy or you sell shares, and you need to host an annual general meeting, so you don't have that data to see how the share price fluctuates with the market, okay, because shares are not bought and sold regularly. So beta is an important input in valuing a company. So when we want to value an unlisted company, what you can do is you can take the betas of similar companies that are listed, you can calculate the betas of those companies, and then you can use those betas as an estimate for the beta of your unlisted company. The problem with that is these listed companies probably have a different capital structure to your individual company, okay? So the higher a company is geared, the higher the beta, generally speaking. And you might find that your private company has got very little debt, but all similar listed companies in the same space have got a lot of debt. So if you just blindly take an average of those betas and use them as a proxy for the beta for your unlisted company, you could get some misleading results. Maybe their betas are artificially high, or not artificially, are relatively high. And what that causes is it causes a lower valuation for your company because you'd be using a higher beta than what is accurate for your company. So traditionally we use historical data to measure the beta of equity, okay? However, our company is unlisted, so we use similar listed companies to estimate the beta of our company. Each of these listed companies would have a different capital structure to the company we wish to value, and this would affect the volatility of these companies. And this causes unnecessary noise, or it's a reliability issue. You can't really rely on that information because they have a different capital structure. So the betas that you get by doing that regression analysis on the listed companies, that beta is called a levered beta because it has the leverage of those listed companies already built into it. Okay? You can strip out the capital structure of each of these listed companies to derive a measure of pure relative risk regardless of gearing. So what you're going to do is you're going to somehow strip out the effect of the gearing of those listed entities, and you're going to get what's called an unlevered beta of those listed companies, a beta measure that excludes the effect of whatever debt they have on their balance sheets. And then you take the unlevered beta and then you convert it back to a levered beta, okay? But this time you put the leverage of your private company that you choose to that you've chosen to value, okay? And that's how you'd use levered versus unlevered beta. So you take the listed companies which are levered, you remove the effect of the gearing to get them to unlevered betas, and then from then on in, you then apply the leverage of your company that you're trying to value, and you convert it back to a levered beta, and then you do your valuation, and then you can calculate your cost of equity, your cost of debt, which gets plugged into your weighted average cost of capital formula, and then you do your discounted cash flow valuation. Okay, so how do we strip out the effect of gearing and arrive at an unlevered beta? We need to make a lot of assumptions, okay? So just hold on tight. We need to assume constant debt outstanding, okay? So it's best to do this if you have a company that's already at steady state. So steady cash flows, and the company has got a long history of maintaining certain profitability ratios and a certain level of debt. So the company's stable. Then this methodology will work a lot better. So assume constant debt outstanding, debt costs, constant interest rate, in other words, constant tax rates, and that the company would always be profitable. In other words, it would always be paying tax in perpetuity. Why that is important is when a company has debt, the company can reduce their tax bill by the amount of interest that they pay on that debt. That debt is what we call interest deductible. So you take your operational costs, and then you subtract your interest expense, and then you calculate your taxable profit. So your taxable profit is decreased by the amount of interest that that company needs to pay. Okay, we call that deducting your tax, or it's tax is interest is tax deductible. Okay, and the amount of that deduction is called your tax shield. So if we think of the value of a company, that tax shield has got a benefit because it means that you're paying less tax to government. Okay, so you're still deriving the value from borrowing that debt, but you're paying less tax to government because the cost of that debt, you don't have to pay the government tax, and you have to pay whatever lending institution interest. You can offset the interest expense against the tax that you pay the government. So that's a benefit to you. So you have to consider that benefit when you're valuing this company. So you can think of the value of any company as the value of what that company would be worth, same cash flows, okay? But if the company had zero debt, if it had no tax shield, okay? So if the company makes 100 in profit, it pays tax on that 100. Whereas now, if the company makes 100 in profit, you take the interest expense, let's say the interest expense was 10, you deduct it from that profit, and the company would only pay tax on 90 worth of profit. Okay, so that value of reducing the tax burden, you need to incorporate it into your valuation of the firm, and that's the value of this tax shield. Okay, so we can assume that every single company can be expressed, its value can be expressed as the value if it was unlevered plus the value of its tax shield. Okay, we assume the listed company has constant debt levels, tax rates, and debt costs over time in perpetuity. And then the value of the tax shield is given by the debt times by the interest. So that term just gives you your annual debt cost times by the tax. Because this is, as I mentioned before, let's say the company pays interest on, it makes profit of 100 and it pays interest of 10. Okay, let's say the tax rate of that company or of that country was 30%. Okay, you've reduced your taxable income by 10, so you pay 10 times by 30% less in tax. So you pay 3 units of currency less in tax. Okay, so this is your tax shield, in other words, and the I will cancel out in the numerator and the denominator to give you just the overall debt amount times by the tax rate that you pay. Bear in mind that you're valuing this, you're doing a valuation now, so you're valuing this into perpetuity. And the formula for perpetuity is just 1 divided by the rate that you're using to discount those cash flows. So that's where this I comes in the denominator. So the beta of the listed company can be decomposed into the portion of that company's beta caused by unlevered operations and the portion of its beta caused by the tax shield. So we have a beta. The company has got a beta, which we've done the regression analysis. If we just split up that beta, hypothetically, we just do a hypothetical weighted average of the proportion of that beta that comes from the unlevered operations of this company and the proportion of the beta that comes from the fact that this company does have gearing on its balance sheet. If we just do that decomposition, so we have a beta and we just split it up into the beta that's attributable to just operational and then the beta that's attributable to capital structure. Okay, that's basically what we're doing here. The same beta. Okay, we just decompose it like that. The weight of the unlevered portion is just the value of the company if it were unlevered. Going back to this formula here, this is the value of the firm that is attributable only to its operations. Okay, in other words, if it had no debt whatsoever. Okay, so this is the value of the company unlevered divided by the total value of the firm, which is just the value unlevered plus the tax shield. And the weight of tax shield is just going to be 1 minus the weight of unlevered. In other words, it's tax shield divided by the value unlevered plus the value of tax shield. So weight of tax shield is just 1 minus weight of unlevered. So then we have the beta of a company can also be decomposed into the portion caused by its debt and the portion caused by its equity. So if you add debt and equity, you get assets. So it's just like a balance sheet. Okay. So you're using the same beta that you got from your regression analysis, but you're just using different weights. Okay. And this time you use the weight for your debt and the beta that is attributable for the to the debt, and the weight for the equity and the beta that is attributable to the equity. Now, since you're dealing with the same company and hence the same overall beta that you used for your regression analysis, you just equate both equations and then you obtain the following. You equate this first equation here and this equation here, and you get the following. Okay, your weight debt times your beta of debt plus your weight equity, beta equity, is equal to your weight unlevered times beta unlevered plus weight tax shield times beta of debt. Now it's important that you bear in mind that you apply the beta of debt to the weight that is attributable to your tax shield, because your tax shield has to do with debt, okay, essentially. So you land up with this formula over here, and for simplicity we can make the assumption that the value of debt is not correlated to the value of the market or the stock market. In other words, if you owe a firm $100 million in debt, it doesn't matter whether the stock market rises or falls, the debt is still worth $100 million. Okay, so you can assume that the beta of debt is 0. In practice, this is not true. What tends to happen and what we're seeing now is when the economy is doing very badly, interest rates are lowered across the economy, and this has it has an effect on the value of the debt outstanding, especially if the debt is in the form of bonds which are traded. The actual value, purchase value of the bonds tends to go up. So another thing is when the economy is doing bad and you're looking at debt on the syndicated market, secondary market, if the overall economy is doing bad, then the amount of spread that secondary market purchasers need in order to buy that debt tends to go up. So there is in fact a correlation between the value of debt and the value of economic activity. But for now, for simplicity, we just assume that the beta of debt is 0. So if the value of beta debt is 0, this term disappears, and on the right hand side of the equation that term disappears, leaving us with this formula: weight equity, weight unlevered, beta unlevered. We can solve for beta unlevered, which is what we want, to obtain that formula. And after some algebra, we arrive at what's called Hamada's equation, where you can go from an unlevered beta to a levered beta, and a levered beta from an unlevered beta by taking 1 minus the tax rate over the debt to equity ratio, and you can just use this conversion ratio. So essentially what you're going to do is you're going to take these levered betas that you get from these listed companies, you're going to apply this factor, and after applying this factor you're going to arrive at an unlevered beta. Okay. And then what you will do is you will take the beta of the you will take the beta of the company, the unlevered beta, and you will then re-lever this beta according to the capital structure of the company that you want to value. Okay, so then the levered beta is then the unlevered beta, and then this is the debt equity ratio of the company that you wish to value, that private company, the unlisted company. So just in conclusion, you'd use unlevered betas when you are trying to value a company where you don't have sufficient history and you can't reliably estimate the beta of that specific company. So then you need to use another company as a proxy for that specific company. So I would use an unlevered beta if I'm using another company for proxy of the company that I'm actually trying to value, okay? And then I'd re-lever that beta again to take into consideration my capital structure, or the company that I'm trying to value, its capital structure. Because if you don't, then your valuations are going to be a little bit off. So just in conclusion, some interesting characteristics of betas. Generally, you look at the industry, if the firm is selling luxury goods or necessity goods, expensive or cheap, generally the more choice that consumers have, or the more, the higher the presence of substitutes, the higher the beta. In other words, the more volatile that company is relative to the overall economy. If you're selling highly luxury goods, in other words, people have a choice whether to buy a gold chain today, or whether to go on that very expensive holiday. They have the choice to defer that. So when times are tough, they will defer that. So it makes such industries highly volatile, which means a higher beta. Is the industry cyclical? Again, cyclical industries have a higher beta. What stage of the business life cycle is the company in? Business life cycle, if it's an early stage company, it tends to have a higher beta. If it's a mature company, it'll have a lower beta. If it's declining, if it's losing market share, or if it's reaching the end, like the VHS or DVD companies, manufacturing companies, they're declining. It's becoming a lot more, streaming is becoming a lot more of a disruptive technology in that space. So, you know, when there's an alternative, people will just switch to the streaming. So it makes these companies a lot more volatile, but in a bad way. So they have higher betas because they're in decline. So again, just looking at some of these industries, groceries, you can't defer, you need to eat. So it's got a low beta. Whether the economy is doing well or not, you need to eat. Residential property, depends. If it's for leisure, like Airbnb, very high beta, especially during COVID. But if it's the house that you live in, you'll pay the rent no matter what. That's your first expense. Jewelry, restaurants, high beta because you can defer that. It's luxury. Okay. The last thing, cost structure, as we talked about before. Does the firm have high fixed costs or low flexibility in changing output? We talked about this in last week's webinar. If you have high fixed costs and you need to cut production, you don't have as much leeway to do so because you still incur those costs whether or not you produce. We talked about it earlier in the context of the mining industry. If you need to constantly pump water out of your mining shafts, you need to do that whether or not you're producing. Even if you cut production by 50%, you still have to run those pumps. So high fixed costs mean that in good times, your cost base stays constant, but your profitability goes up, which is very good. But in bad times, your profitability goes down, but your costs stay constant, which is very bad. So that makes these firms have a higher beta. Good times are really good, but bad times are really bad. Okay. I hope you enjoyed this webinar. Please click subscribe, and if you like the content, please click like. If you have any questions on this webinar or any past webinars, feel free to comment below. And if you're on YouTube, or if you're part of the Tauro Group Education LinkedIn group, please leave your questions and we can discuss it as a group, and we can grow together through shared experience. I hope you enjoyed this, and my name is Barry Fisher from the Tauro Group. Thank you very much.